Morning, I'm Daryl Jones, Director of Research at Hedgeye. Welcome to our webcast today. The mother of all bubbles is popping. Catchy title, but we're going to get into some granularity on all this. It sort of reminds me of the famous Chinese adage, may we live in interesting times, because I think that's exactly what's happening. So sort of the sequence of events today is we're going to start with Josh Steiner, who is really going to kind of get into what happened, in particular with the banks and how this all kind of started a couple weeks ago. We'll kick it over to David Salem, who's going to provide us some longer term and historical context. And then Keith's going to chat a little bit about the here and now, the positioning, the setup. And then the idea is to get into some Q&A and back and forth. But with that, we will start it off with Josh. Thanks.
Yeah, so I think I'll only spend a minute or two sort of recapping, what's happened. I think most people have been generally trying to keep up from a news flow standpoint, but the big picture is sort of an old story, which is that you sort of have partnered up, volatile assets, in this case, actually government and agency securities, not volatile from a credit standpoint, but from a rate sensitivity standpoint, with what is effectively fickle funding. So we don't normally think of bank deposit funding as being fickle, but in two respects, it increasingly is. One is the idea around low or no interest-bearing deposits, and the other is the area that's really sort of gotten the bulk of attention of late, which is, of course, uninsured deposits. And just to contextualize, you've got roughly 55% of insured of deposits in the system, which is currently around 17.5 trillion insured. The balance, so roughly 7.5 trillion uninsured. So that dynamic has sort of been there for quite a while. I think what's interesting about this environment, and one of our colleagues, Christian Drake, wrote a great early look on this called Valhalla, as in volatility Hala, recently, where he sort of laid out this idea that, if you have these ingredients, these preconditions, they don't necessarily matter up until you get to what we would call this sort of protracted quad four environment. And then all of a sudden, you have sort of the tinder to make these kinds of events not only possible, but somewhat likely. And the sort of situation that got everything going with Silicon Valley was really sort of a perfect storm of this confluence of events. So you had, of course, as we all know, very high levels, something like 95, 97% of the deposit base uninsured. You had a tremendous concentration of depositors in the form of similar, tech-based, largely VC-based individuals and companies who really all sort of, thought about things in largely a similar way, skipped to the same drummer and so forth. And then, of course, you had this, revelation that the companies, available for sale, securities and HTM securities, which were very underwater, effectively rendered the bank insolvent on a mark-to-market basis. So that was kind of the recipe. And then all of a sudden, you had, sort of online media really accelerating this old, it's kind of a modern day, old school bank run. So, of course, Silicon Valley couldn't accommodate the requests for deposits. It had to liquidate its AFS book. It talked about, incurring almost a $2 billion loss in that process. That happened right around the same time that Silvergate announced that it was winding down its operations. I don't think those two things were sort of, not interdependent from a relevant standpoint. And all of a sudden, you had this rush for the exits. And then within a very short span of time, so, Silicon Valley, big bank, 200 plus billion in assets, 16th largest bank in the country. Then very short order, you had Signature Bank, which, was a further 110 billion in asset bank over the weekend, get shut down. Obviously seeing a lot of the same dynamics there. And now where we are today is, First Republic is obviously, very large, important bank, 14th largest bank in the country, similar assets to Silicon Valley. And by most measures, they've had massive deposit outflows, some published estimates of around 70 billion. That's been partly replenished. There was a $30 billion injection over the weekend by a consortium of 11 of the biggest banks in the country, trying to stem the tide, a la what JP Morgan did back in the 1907 panic. But even with that, we've seen continued massive volatility, continued weakness. The concern really with First Republic is that there is a very large hole when everything is effectively marked. And any bank that wants to take that on is going to have to reflect those negative marks and therefore that hole. And so that creates obviously a lot of friction, a lot of difficulty. And what I thought I'd do is just sort of frame up. So that's kind of a quick history of what happened, but I wanted to spend a few minutes just talking about a few other sort of elements or implications here on a forward basis. One is implications for lending. So Powell talked about this a bit yesterday when he went through the expectations for a credit crunch or credit contraction in the wake of all of this bank chaos. To put it in context, small and mid-sized banks, and by mid-sized banks, we're still talking about large institutions. This is any bank up to 250 billion in assets. So really anything outside of like a top 10 bank in the US, they collectively account for about half of all C&I lending, about 80% of all CRE lending, 60% of non-agency residential real estate lending, and 45% of all consumer lending. So we're talking about a very significant portion of the banking system. And system-wide, you've got unrealized losses as of year end on HTM securities at 341 billion and on available for sale securities 280 billion. So combined for 620 billion of year-end unrealized losses. So I think a couple slides just to punctuate this a bit, kind of run through here. So from our quarterly macro themes deck, maybe we could take a quick look at slide 34. I could spend all day sort of talking about just a couple of these slides, but I'll try to keep it tight here. So on the right is basically a look at the money supply in the US growth year over year since 1960 to the present. 2022 stands out because it was the first year in the last 60 or so years in which the money supply actually contracted. That obviously is a big part of what's giving rise to the dynamics we're seeing today, to the popping of the everything bubble. On the left side, and this is about to become probably everybody's favorite, low frequency government data series, the Senior Loan Officers Opinion Survey from the Fed. They put it out quarterly. On the left is our table, which is a summary of their consumer lending. Essentially, what you're seeing is this trend toward tighter underwriting, wider spreads, and reduced demand for lending products. If we fast forward here to slide 61, just a real quick sort of take on the C&I portion of the survey, which goes back to 1990. So for 33 years, they've asked loan officers across the country the same three questions. Are you tightening your underwriting standards for commercial industrial lending? Are you increasing spreads on those loans? And are you seeing stronger demand for those loans? And what has happened over that time frame is every time you've seen two of those three questions turn net contractionary, you've had a recession. So currently, all three of those questions are contractionary and have been so now for 2 quarters in a row. The current survey is going to go out to loan officers in the next week or so. It'll be out there for about 2 weeks, and then they'll put out the results of that survey in mid-April. I think we can all sort of guess as to what those survey responses are likely to look like. But what I would say and what I would leave you with is that bank lending is autocorrelated. It tends to feed on itself. In other words, when lending conditions are tightening, they create economic slowdown, rises in unemployment, rises in business failures. that precipitates worsening credit quality, rising delinquencies, rising charge-offs, and then that triggers further contractionary underwriting dynamics. And that system is, an autocorrelated feed-forward loop that reflects on itself until it runs into a circuit breaker, and that circuit breaker is typically the central bank making money less expensive, encouraging risk-taking, and so forth. So, at least based on what we heard yesterday from Powell, that is not in the cards anytime soon. Yes, they may be nearing the end of the tightening cycle, but there's no indication that they're going to be easing back. So QT is still in full effect. We're going to be higher for longer based on still very low unemployment and still very high inflation. So that's really the sort of precondition set. I could go on, but I don't want to just make this a big lecture. So I'll pause there and pass the baton.
Sounds good. Yeah, we will move over to David now, who's going to, I guess, provide some sort of longer term or historical context based on his experience. So with that, David, it's all yours.
Yeah, thanks, Daryl, and thanks, Josh. Great job. If Genron, you could put up my first slide. I want to just speak to this topic of history. I do think we do have history in the making. I will say as an aside, I never thought that I would witness events in my career that could be accurately described as the mother of all bubbles, having lived through both the Japanese bubble in the late 80s right into 1990, and then again the dot-com melt up and then melt down. But I do agree with Keith's characterization of where we are. This is probably my single favorite quote about history and history making and history writing. It comes from one of your fellow Yaleys, Keith, but I don't think any relation.
No.
I did have the privilege of spending a fair amount of time with David. He was a wonderful man, and I just love this quote. The end of it in particular, that the people that he was writing about and researching didn't know how it would all turn out. Nor do we. We don't know how all this is going to turn out. And I think that highlights one of the great virtues of sort of the Hedgeye process, which is that it's always, everywhere, uniformly probabilistic. We're never really certain about anything, and I think that's a really important point. And if I can answer preemptively, Keith, the question that you raised on the, I think it was the macro show this morning, but it may have been the call, why did I give you Steve Magnus's book? It's, to underscore the importance of becoming comfortable on our discomfort, right? We don't know how this is all going to turn out, but we can do our best to analyze it. The next slide, Eric, if you don't mind. Josh has mentioned, I think as recently as yesterday, that poor Jay Powell, he's either in the frying pan or the fire. And I think that's a good way of describing it. But I do think as we reflect on history, I think the problem is also aptly characterized as the famed trolley problem. And you're all familiar with this, with the actor in the middle with the switch gets to decide, does the single person in the lower right die, or do the larger number of people in the upper right die? And that's a real dilemma. We could probably argue and get back to it later, Josh, that maybe Powell is facing a trilemma. But I do think this problem, this challenge that he's confronting is importantly rooted in history. It goes really back to the founding of the Fed in 1913. And that is a topic that I don't think we have time to explore today, although we may get into it a little bit later on. I'll just as a teaser say that I was delighted, and I think Josh was too, to learn that I think the world's leading living historian, and maybe the leading historian ever, of the Panic 07 and its aftermath, which led directly to the Fed's founding, is going to do a real conversation with Josh, Steiner, and me at 3 p.m. on April 3rd. His name is Bob Bruner. He's the former dean of the Darden School at the University of Virginia. Just come out with the second edition of his really definitive study of the Panic of 07. And even though that was a long time ago, I think it has really important lessons for us to learn and to reflect on the full distribution of plausible outcomes from what we're going through right now. Next slide, Eric, real quick. Another favorite quote. This is actually a paraphrase by me of musings from Edward de Bono, who is famed for his teachings on lateral thinking. But I think the key thing here is the notion that people tend to arrange and sort newly arriving information into pre-existing patterns until a piece arrives that simply cannot be fit into that pattern. And then everything gets tossed up and rearranged. Now, of course, our colleague Neil Howe has talked about this a lot, and I look forward to some real conversations with Neil in the future. So he's sort of the leading student of this. But bringing it back to the next slide, Eric, to where we are here and now, I think that we can benefit from asking ourselves, are we at an important inflection point, singular, or inflection points, plural, in the march of global capitalism? And I've had the great benefit in the last several days, my colleagues know this, that as I intensely focused on designing the new service that we're launching called Capital Allocation Pro, I've just been reaching out to, frankly, a fairly large number of asset allocators, essentially to try to get product market fit, but also to get their ongoing views on what's going on contemporaneously. And so what I've tried to distill on page 4 here, or slide 4, mindful of the acute time constraints, are just the key questions that are arising that I'm asking myself and that some of these other allocators are asking. So very quickly, and I'll turn it back to Daryl, has China become uninvestable? The consensus I'm hearing is that definitely on the private side, maybe not yet on the marketable side. We can come back to all of these, including that one, as my colleagues see fit. Venture capital, when, if ever, will the outgoing tide reverse? I've had some really illuminating, even comical conversations with people that are really in the know and immersed in that community. I do think that as with the bank balance sheets, we have a big problem of which you're all aware with the stale marks, the marking to market process in venture capital and in private equity, and turning to the next bullet in commercial realty. How bad will it get? I think the emerging consensus I'm hearing is very bad indeed, obviously, particularly for offices. Banks, I want to sort of combine the last 2 bullets, Josh, and whether you answer it immediately or before our hour together today ends, I'm really curious to know. This is not an original thought, but the idea that what we've essentially seen through the authorities' handling of SVB, Signature, and all events that have unfolded since is essentially a de facto nationalization of liability side of bank balance sheets. And this does go back, we won't go back to the slide, but think about the trolley problem, because the Fed has created an environment that is completely unsustainable for banks, which is to say an inverted yield curve. And so that problem, coupled with what seems to be the de facto nationalization of the liability side of the of the balance sheet of banks, to me raises a really serious, I think almost profoundly important question about American capitalism, which is, are our banks essentially stranded assets? They've always been they've been heavily regulated. We call other companies regulated utilities. Are we at the point where, serious, thoughtful investors are going to say, I just don't want to be on the equity side of that capital stack because of the rules and regulations to which they're likely to be subject moving forward, coupled with one other phenomenon I just want to highlight, and again, we can come back to it or not. It's coming up a lot in my conversations with serious allocators, which is the idea or the question of whether the launch of a US CBDC has become inevitable. Indeed, some people in recent days, recent hours have said to me, it's already happened, David. And that ties into the idea that if we've de facto nationalized the liability side of bank balance sheets, that coupled with the phenomenon, Josh, I'd love to hear you discuss today or later, which is the pending launch of FedNow in July, the instantaneous transmission 24/7 of dollar credits and debits, whether that doesn't put a final nail, if you will, in the coffin of many banks, if not all U.S. regulated banks. So with that, Daryl, I'll stop and turn it back to you.
Okay, great. Very helpful context. Now we're going to have Keith chat for a bit, just in terms of what he's seeing in the here and now, so particularly with given yesterday and the action yesterday. So,
how much can we learn in 20 minutes, Jonesy? Huh? From two of our teammates. It's like it's a blessing, to play on our team, because there's so much knowledge, and to David's point, you'd have to have a severe amount of arrogance or humility to actually know how this is going to end. Now, just knowing all the components, let's just start with that, or having a level of macro awareness. And David said this too, it all started with Quad 4, don't forget. So the conditional probability is that we have those conditions. We have the rate of change of growth slowing, we have the rate of change of inflation and therefore profits slowing, at the same time. That's the definition of quad 4. That means the risk starts. The risk started 15 months ago. That's not new. So again, what we've seen in every other major market crisis, Jonesy, is that people tend to go right to the rabbit hole, or they go, as a macro tourist would, they go right to the headline of the day. Like, as long as we can save First Republic Bank, then we can buy Google today. I mean, that is absolutely the way that they thought about it in March of 2001. After one of many bear market rallies coming out of a growth bubble, it's exactly what they're doing today. So the behavior is actually quite similar. When you look at a market crash or the components of things that people say and do as a bear market's trying to find its final, or what we would call phase 3 of the bear market. But just to bring it right back to the screws, like the main things that caused David Salem to say what he said about the banks, or Josh Steiner, or the credit cycle that we're in, are that we're actually just about to go from that slide 61 to if we just show you one more time, think of how long it takes for a recession to play out in terms of the red bars on that chart. We just started, okay? So that's the context. You don't know where it's going to stop, but I do know that it's not going to stop tomorrow. That's an important point. Or it's not going to stop and start because the S&P 500 goes up or down 100 basis points. The next point on slide 69, which we'll focus on when we get into our macro themes update next week, we're going to have our Q2 macro themes. Our Q2 macro themes are as follows. Profit recession, quad 4 profit recession, reiterated. Credit event, reiterated. Long gold, reiterated. Note the 3 times I used the word reiterated. So again, it's really simple actually to understand. It is much tougher to simplify the complex in that regard. And the market really starting to see an opportunity here to get long duration, get long gold. That's giving us higher conviction, or the market actually has higher conviction that this bubble, if you think of all the mother of all bubbles and all the components of the bubbles, it was born out of a rate of change acceleration in GDP growth to 12% year over year, which is the largest ever. It's the profit mountain that you see. The banks and their liquidity and all the tomfoolery and behavior embedded therein at Silicon Valley Bank is based on the arrogance that they thought that those cash balances were going to remain at cycle peaks. So now we've just come off the cycle peak. And look what's already happened. Just like 6% off the mother of all. We can debate, and I do appreciate that, David, what is it, Japan? Is it .com? I don't think it's any of the above. I think that this is its own mother of all bubble, and it's born out of that mountain, which is by definition the mother of all peaks in terms of the rate of change of revenue growth and profit growth. So anything that falls out of that is based on reversing the prior behavior. So to me, and if you go to the next slide, actually, the first phase 1 of a bear market starts where the profit, or the rate of change of both growth and inflation, and therefore profits, peaks. That's called quad 2. That's exactly what happened. We had a longer term tail here on the inflation components. You had cyclicals maintain a high and almost anomalous profit growth by any cycle's perspective for longer. Energy stocks, industrial stocks, utility stocks. Why are those stocks, why aren't they like up today? Like if you look at where we're at today, it doesn't really matter relative to where we're going to be by the end of next week or 10 weeks from now. It's very much properly like it was in 01, stepping down. When the rate of change goes negative, it's one thing. When profits actually go negative on an absolute basis, it's entirely another thing. And that is because the credit component of the market, which is, I don't think anybody would disagree that you don't have the mother of all bubbles in high yield and junk and CLO, et cetera, credit. I don't think there's any, like just in terms of the size, if you want to define a bubble by virtue of its size, or how it's all intertwined with private equity, venture capital, real estate. That's what the market, Jonesy, I think has really been unnerved by.
Yeah.
So guess what? Now that that's all happening, it's okay. You just don't buy that stuff. That's a lot of stuff. Like the entire venture capital, private equity, real estate, complex, that's a lot. I would say that Barry Sternlicht's tone this morning on CNBC reflect some level of anxiety associated with that. So you go buy Magma. So I used the analogy today. If you can't buy any of that, any of the former bubbles, you got to go back to not the former bubble, it's still a bubble. Tesla still is a bubble. Yesterday when people are buying, so when we think about Magma, we're not even including Tesla. Magma is the new acronym, and you know how the acronyms change. There used to be a brick bubble. Remember that one? The Goldman Sachs, this time is different, buy the bricks, okay? We used to have the FANG. Well, then the guy screwed up the name and the Facebook component came out. Okay? So that bubble is still alive and well. Tesla, which is not even in it, or NVIDIA for that matter, because we need to go to the liquidity. We need to find liquidity in the big ideas. So AI is NVIDIA, Tesla is Elon, and the magma is where we're all going to go one more time, okay? So this is a problem. It's a major problem. Because, of course, the magma, the companies are not going to be able to not report economic reality when GDP is negative, okay? So if you think Microsoft isn't sensitive to the economy, or if you thought Google wasn't, you definitely had an education last year. So I think that it's a real interesting setup from a market perspective, and I'll stop here because I want to get into the back and forth on this, Jonesy, but I used the analogy earlier this week that this is essentially the Titanic. The Titanic, you've seen multiple components go under the water. Just put BC. Well, actually, we haven't even seen them take their marks. We don't know how far they've sunk, and or if they haven't sunk to the bottom, when the bodies surface. Okay, we've seen that part of the Titanic go to where it's gone. Everyone crams themselves up on that last part of the Titanic that hasn't gone down, and it's called magma, Tesla, NVIDIA. And then they have to report reality. So that's the problem. By next week, 90% of the S&P 500's buybacks will be blacked out, and we will enter the reporting of reality. And that, again, quad 4, I think, is the easiest way to short circuit it. But obviously we're quite bearish, and I don't think that the intraday behavior based on the Fed yesterday or the intraday behavior today is going to change. If anything, that behavior until it stops. 272,000 weekly call options that expire tomorrow in Tesla at the $200 strike. They all need that to pay up. Think about that behavior. It's certainly not behavior that I've ever engaged in, but it's certainly bubbly behavior.
All right, we're going to start off by going back to Josh for a second. And Josh, one question I want to ask you is sort of, in terms of the banks specifically, what's sort of next? Like, what do we think could happen? There are obviously a few other banks that are distressed, especially if you look at their stock prices. And the other component you mentioned was just the amount of lending that comes from these, for lack of a better word, mid-sized banks. Does that capital or credit really dry up, which has some second derivative effects on the economy as well?
Yeah, it's a good question. I think every crisis, it seems like there's sort of one or two, defining sort of charts or graphics that go along with it. So in 2008, you had the sort of schedule of mortgage resets. So you could, the 228s and the 129s, so you could kind of see when the pain points were going to be coming. In 2011, amid the sort of, European sovereign debt or PIGS crisis, there were these great graphics sort of describing the sort of cross holdings among the big European banks of, obviously distressed European countries, sovereign credit. And then this time around, there are basically XY charts, scatter plot charts, basically showing some sort of version of, uninsured deposits as a percent of total on one axis, and then unrealized negative marks either in just AFS or on a combined AFS HTM basis on the other axis. And that seems to be how the market is thinking about this. And I remember back in 2008, it really became this sort of one factor exercise to run through the regional banks and look at exposures to second lien residential exposure as a percent, let's say, of tangible equity, right? And you would just rank the institutions, and that would be your sort of simplistic pain factor model. So this XY or conjunction model is sort of where people are focused. I think you can decently proxy which of those institutions are in the worst place on those charts simply by looking at their equity prices. I think the markets, tends to be decently efficient at figuring these things out. I think the challenge here is that there were a lot of lessons from '08. And one of the big ones that is relevant today was really the sort of misadventures of Bank of America. So if you recall, B of A went in and bought Merrill Lynch really very, very shortly before Merrill Lynch was going to collapse, right? And they paid full price, basically. If I remember right, they paid, I think it was about $50 billion to acquire Merrill. And I mean, it was so close to the precipice that had they, waited literally a day or two or even hours, they would likely have gotten it for free. And, and then a similar dynamic, they didn't pay full price, but they bought Countrywide. And ultimately, the mortgage putbacks associated with Countrywide ended up costing them tens of billions of dollars. So it was almost like they did pay full price. And that's really the challenge here, is that as these banks fall into distress, the bigger banks are perfectly happy to take the assets and deposits off their hands, but they want to do so at basically no cost and with a government guarantee. And that's where the challenge obviously arises, right?
Yep.
So nobody wants to step in there early and do this.
Okay. Just one quick follow-up, which you didn't touch on too much, but you're more focused on the regionals in the U.S., but Credit Suisse and the implications there, is that more of an idiosyncratic situation where Credit Suisse was just, a troubled bank, and we knew this for years, but, how does that interplay with all of this?
Well, it's a little of both, right? It's idiosyncratic, it's systemic, and anybody who would just sort of say, well, Credit Suisse had a lot of problems, so nobody should be surprised, I think is kind of missing the bigger picture. The bigger picture is that we've been in a Quad 4 and really a global Quad 4 for some time now, and that, like I said earlier on, creates this condition set that takes weaker institutions and puts them in a much more vulnerable position, right? And so, yes, Credit Suisse had a lot of specific issues. Yes, those issues go back a long ways. And ultimately, one thing that ends up sort of creating the death knell, if you will, for these big banks is when counterparties no longer are willing to transact. And you can proxy the probability of that happening by looking at the credit default swap levels. So we have been watching CS CDS for quite a while, and as it crossed up over that 300 level, you knew that the risk was rising very significantly. And then ultimately, that was in fact the final trigger catalyst for the Swiss central bank to step in and basically force a shotgun wedding between UBS and CS.
Yep.
Because ultimately there were probably hours left.
Okay. We're going to go to the top of the queue here. This, I think, is maybe more of a question for both David and Keith, and I'm curious to get David's perspective from his prior background. But this is from Lee. Where can a long-only manager that needs to be 98% invested allocate over the coming quarters during this Quad 4 environment? And, this is, as we talked about, the challenge that a lot of money managers have. They actually have to be invested, to sort of think about how to position for the next few quarters, especially if we're still in sort of the third component of this unwinding and things have the potential to accelerate from here.
Yeah, when you're in a liquidity crisis and everyone needs liquidity, the number one factor you should have in a long-only portfolio is liquidity. So the feature position would be the U.S. dollar. That's a Quad 4 position. Gold and physical gold, in addition to GLD, which is, of course, paper gold. I'm just looking at our current asset allocation. Gold miners, less so we'd be sizing the equity components down, because as we get more and more of these big bangs, and really we haven't even had some of the biggest yet. I mean, I can't wait to hear what Blackstone has to say about BREIT on their next conference call. I mean, we're talking about big things, Jonesy, that need to happen. And adding duration finally. I think that now, at least from a signaling perspective, the market has signaled, and this is what a lot of people miss going into a recession, is that never mind the Fed staying with a rate hike and not saying I'm not going to cut rates. When the Fed says they're cutting rates, it gets worse. But most people who haven't risk managed through a recession before don't quite get that. That's where you get paid being long duration. So that should be a major asset allocation that
Yep.
we're just finally getting the green light on. So we have BNDD, which is like it's an ETF that I just signaled on. Extended duration bonds, EDV is another allocation there. I do think that corporate credit, if it is defensive and visible, the street has said you go buy liquidity through buying the magma stocks, right?
Yep.
I mean, but that's not what we're looking to do.
Well, yeah, I was going to ask a follow-up on that. If you're looking at, I guess, equity style factors, you need to own some stocks. What are the equity style factors? Is it value? Is it large cap? Is it
if you look at
strong balance sheets? I guess it's
slide
the liquidity comes into all this, right?
Yeah, we have a nice tidy slide on this on slide 8 in the current macro deck that shows you the factor exposures that you'd like to see. So you want to see low beta, you want to see liquidity, you want to see cash flow visibility, and that's what people want to believe they have, because in many cases, you do have good balance sheets and you have obviously cash flow at the magma companies, but you also have rate of change slowdowns in revenue and earnings, which is the bigger problem. I don't envy somebody who has to be 98% invested. I actually think that that's the wrong answer to start with. So I think if you haven't been able to battle test your employer or battle test whoever puts you in that position in the prior 2 recessions, I think you would have liked to if you go back.
Yep.
I don't have that. I don't have that problem. I mean, currently, I have plenty of cash, and I'm ready to deploy that in duration. I think that that's a great opportunity. There's only so much gold you should buy, or you're going to have like this massive position that doesn't create any diversification. So,
so flipping over,
David probably has some.
Yeah, I'm curious to get your thoughts, and also, if you're sitting at a large pension right now, where again you can't really move the dial that much. But what types of things are you thinking about? Also respecting that we're at least part of the way into this, and we don't know how long it goes. But how do you position, for the coming quarters and what we see could potentially happen?
Yeah, let me just jump in with a sort of philosophical observation for what it's worth, which is that I do think, and Neil's been again terrific on this, Neil Howe. We are going through an epoch, if you will, characterized, generally speaking, by declining trust. To trust in institutions, to trust in individuals, and it's seeped into the world of asset allocators, right? Because you do see these constraints, and when you look at them and study them and comment on them, as I have extensively, what jumps off the page at you is that these people don't trust each other. They're saying, Keith, here's my money, but you must keep it 98% invested, right? And you know this better than just about anyone in the world. You can honor completely the letter of all of those constraints and completely violate their spirit, right? Because the spirit is we want you to stay within. We don't want you to be massively underinvested in a bull market, and we don't want you to be over-leveraged to a bear market. That's why the constraints exist. So getting back to your sort of question, Daryl, what are you seeing asset allocators do? What I'm seeing is they're straining against these constraints to the maximum feasible extent. The best prism through which to examine that is one I mentioned briefly earlier, which is venture capital, although it's manifesting itself in large asset owners' exposure to commercial realty as well. Because what you're seeing in the venture arena, of course, as some of you know, is what's called the denominator effect, which is because you have the staleness of the valuations, a lot of venture and indeed private equity weightings within these larger frameworks are over the max, right? Now, in reality, and this is one of the most interesting aspects of the conversations I've been having in recent days, I've asked every one of my interlocutors, if you truly had to market your venture and private equity, how much of a haircut would you, in all honesty, off the record, levy? And the answer is typically about 10 to 15%. In real estate, however, they think it's closer to 30%. When I pose that very same question to what I will call one of the most successful venture investors of this generation, or indeed any generation, and this was just yesterday, and I said, the consensus I'm getting is that the marks are overstated by 10 or 15%. He just laughed instantly and said, that's ridiculous. And I expect him to say, he's made his living in venture, it should be 5%. He said it's way north of 35%. Yeah. So you can see that when you have that in one of the line items that constitute the numerators, but the denominator is itself, frankly, vastly overstated.
Yep.
These constraints that people are having to live with become incredibly problematic. Now, advertisement, I think that commends an approach like Hedgeye. That's why I'm sitting here and why I've joined the team. We can talk about that. Where is the environment going to go? Will we be in a sideways or choppy market for a really long time that will flatter all that? How do you contend with these very problems? Final point, I'll turn it back to you, Daryl. What I'm seeing, this is no criticism of anyone, it's because of the governance structures, is incredible stasis, right? So one of the opening quotes I had in this deck was from De Bono, right? People fit the newly arriving pieces of the puzzle into an existing pattern until one arrives that they simply can't fit into the puzzle anymore. And then everything gets rearranged. And I think we're seeing incredible stasis right now. I'm not seeing a lot of creative solutions to any of these problems. And I think the pressures are just mounting. I'll liken it to you've got your raccoon in the famous garbage pail outside the house, by which you mean specifically, the central bank in Japan keeping yield curve control. But that metaphor is very apt to describe what we've been talking about in the last 5 minutes. Mm-hmm. The pressure is building and building and building and building. When is the raccoon going to simply say, off with the lid, out I come, I'm going to create havoc? And we're getting closer and closer, but we're not there yet.
Yeah, we're on taking their marks. Again, it's right in the window. And it's not just about conditional probability, it's about what's going to happen next in that particular window of clock time, market time, cycle time, and that's what's going to happen. People are going to take their marks. So, if you're a family office and you have a 20 or 30 or some have a 40% asset allocation to alts, well, you're going to have an alternate opinion now of what you should have been doing, and it's too late. I think it's far too late. I mean, how can you? That is the story of BREIT.
It is.
They just had $4 billion in requests for redemptions, and they could only meet a third of it. And on their conference call, they said everything was fine. Like it's not fine, and that's actually one of the more promised to be, or was supposed to provide annual liquidity, if I'm not mistaken.
Exactly.
Whereas these other, I think the rich people, the people with all the money, which is why you see the emotion that, like, Bill Ackman just cannot tweet enough asking for it to stop. It's because the people that have been paid by this system for the longest period of time to be illiquid and not take marks are really sitting there knowing, I think essentially, that the raccoon's coming out of the garbage can.
Yep. So Josh, I'm going to go back to you with one of our top questions here, and this goes to how, by and large, the average American gets paid, which is the value of their home. How do you see home prices sort of playing out in coming quarters, coming years? Obviously we had a pretty epic run, but we clearly have tightening of credit, particularly to your point in small, mid-sized banks. And we have seen a obviously continued deceleration of home prices, but still up year over year. The flip side is we have low inventory. But what are your sort of thoughts as we move forward here? And I know a lot of it does depend on interest rates.
Yeah, in the sort of short to intermediate term, rates are sort of one factor to rule them all when it comes to housing, both fundamentally and from an equity price standpoint. And we've seen that pretty clearly on display, not just in the last 12, 15 months, but in the last 30, 35 years. Going into the pandemic, you had a relatively strong residential housing backdrop. One of the biggest factors is, something that's fairly immutable, which is demographics. So, people on average buy their first home when they're either 32 or 33 years old. And if you looked at the number of people the cohorts of basically 28, 29, 30, 31, 32, 33-year-olds, you had a massive bolus of really the sort of peak of the millennial generation passing through those age brackets. And so that is really creating the fundamental backdrop of demand on the housing side. Meanwhile, on the inventory side, existing home inventories going into the pandemic were pretty low. Certainly new home construction was still relatively low as compared with going into 2005, 2006, when we were building 2.5 million new units a year, we ended up with sort of excess supply of something on the order of 3 to 4 million units. We were in sort of a negative 1 to 1.5 million unit shortage going into the pandemic. I think we know what happened during the pandemic. You had basically 0% rates. That obviously took 30-year fixed rate mortgages down into the sort of high twos, low threes. There was a mad dash for owning property, work from home, sort of, YOLO, FOMO, number of factors, but really just the cost of capital plummeted. And then fast forward to the beginning of 2022, that was sort of the peak. And in the ensuing 12, 15 months, of course, you've had a massive shock on the rate front. That catalyzed a severe contraction, almost a 50% contraction in, for instance, mortgage purchase activity. So we know from the MBA purchase series that went down from about a 300 to about a 160. It's since bounced up a little bit, not all that much. But what's sort of underpinned the market, as you said, is you still have a relative shortage of inventory, certainly existing. And that's really born from the fact that most people are effectively rate locked into their current house or mortgage, right? Nobody's going to want to sell, A, because there's not much to buy, and B, because they're going to have to go from a 3% mortgage to a 6 or 7% mortgage. As far as the longer term, we're basically back around equilibrium in slightly negative territory in terms of HPA or home price appreciation, down from roughly 20% growth year over year. So in rate of change terms, we've slowed by a full 20 points in a relatively short window of time, which is obviously extraordinary. So yeah, it's going to depend on the employment backdrop. It's going to depend on the rate backdrop, and obviously on the supply side of the equation as well. So yeah, I would think that the outlook isn't great, but to the extent that you've got these inventory shortage dynamics, that'll help to keep it from sort of metastasizing into something really, really bad.
Really imploding. Yep. Before I forget, I wanted to ask David about the M&Ms that you brought in the message
actually,
there.
yeah. And Josh, I got one for you too, and we'll send it to you next time you're here. Why M&Ms? When I first got into this business, I learned about M&M, and it meant Modigliani and Miller, who came up with the sort of finance theory that said that the enterprise value of a company doesn't depend on its capital structure, which is ludicrous, and it was discredited. But now M&M means what around here? It means Mandelbrot and Minsky. And I think we really need to stay focused, and this will help you do it. It'll give you some energy. Stay focused on those two M&Ms, on Mandelbrot and Minsky, because I do think we're at we're probably approaching a Minsky moment. Daryl, if you don't mind, can I just throw another question at Josh?
Yeah, go for it.
Based on M&M,
Yep.
right? So Josh, if I were the director of a bank, and I'm glad that I'm not, particularly a smaller bank, and I looked at what the authorities are doing, I said, look, like Powell and the Fed and the FDIC, and maybe even Yellen too, they're doing everything they can to let us survive, to get through this kind of Minsky moment for the banking sector, except for perpetuating an inverted yield curve. I'm on the board, you're the CEO, maybe you're the CEO, hypothetically, for all American banks. And as a director, I say to you, dear CEO, how long can we survive this?
I think it's sort of an interesting dynamic, just as sort of I guess a student of these things, where I look at it and I say, what a profound 180, if you will. If you were to rewind the clock, not that far, just as recently as 3 or 4 weeks ago, the sort of prevailing mantra with respect to bank stocks, at least, was basically that rising short-term rates were positive, as most banks were net asset sensitive, and that would flow through positively to NII, or net interest income, and ultimately enhance the profitability. And that was the view. And then you fast forward to where we are today, less than a month later, and obviously there's a complete reversal with respect to the perception of benefit versus harm with respect to those rate moves. So I think it's profound in that respect. I think the challenge for the banking industry is really multifaceted. I think higher capital requirements, greater restrictions and regulation. All these things have pushed the non-bank financial side of things to be much larger than it's ever been, right? So, you've got something like, 200 and, I can't think of the exact number, but, the non-bank side of things is about half as large as the banking side is now globally. And that's really born from the fact that the pressures on traditional banking continue to grow. And I think the fallout from what's going to come from all this is more regulation, right? Tighter capital requirements, tighter liquidity requirements. Ultimately, you're going to structurally compress ROEs even further. And generally speaking, smaller banks have greater difficulties with that to begin with. So I think the sort of ongoing consolidation across the banking industry is likely to continue and probably accelerate. I think the further down the food chain you are in terms of, let's just say total assets are proxy for size, I think the greater the headwinds generally. So yeah, I think there's a lot of challenges, and what everybody sort of thought of as a strength really was a weakness and a vulnerability, and I think that tells you a lot about the state of the system.
Okay. Next question here is from Mark Allen, who we've all known a long time. I've had some epic tennis battles with him over the years, but I know a lot of people are thinking about this. It's kind of in the back of their mind, and his question is liquidity ? Given the debt ceiling liquidity and the recent swap line changes with all the banking issues, are there more behind-the-scenes liquidity dynamics that show evidence of liquidity being pumped into the system that will allow the Treasury and all central banks to limit the overall downside? So I think if I could simplify it, it's just this idea that at the end of the day, central banks can come in and provide some form of backstop or whatever you want to call it, put or whatever.
I'll let Josh give you the plumbing answer on that, Mark, but I like to think of the answer maybe a little differently than, I don't know, maybe this is what you were thinking or not, but we have the mother of all bubbles now. We obviously have the liquidity problems and credit event embedded therein. But we had the mother of all liquidity provided in 2008, and it was only making things worse. Okay? So even if Steiner is about to give me the answer that I know is not the answer, which is we have, the former CEO of Goldman Sachs leaving tax-free to run the Treasury and go with the Bernanke, that was the mother of all liquidity, and it didn't do anything other than make things worse. So in terms of central bank liquidity, it is a false narrative to say that if they were to find a way, given 2008 or 2001 for that matter, it's not like Greenspan wasn't providing liquidity. Like that's just something that I think about. But Josh, I'll let you get into some of the plumbing. I think we have some slides on that actually, where Yellen was actually providing liquidity, offsetting QT early in the first quarter to begin with.
Yeah, I think it's important to sort of keep in mind that liquidity is somewhat interdependent with volatility, right? So if you look at the move early this week, like Monday in the 2-year yield, that was the largest move in since 1982. So bigger than during the Lehman collapse, bigger than 9/11, bigger than the dot-com bubble or emerging market crises in the 90s. So obviously a momentous event, and when you get that kind of volatility, it can precipitate real liquidity dynamics, right? You get sort of forced selling, you get margin calls. And so, not surprisingly, it has been creating liquidity problems and tensions in the background. And the Fed basically rolled out dollar swap lines with the 5 big central banks. So your ECB, Bank of Canada, BOJ, Bank of England, and essentially put these in place because there were dollar funding shortages that were taking place outside the U.S. And so it was sort of an effort to keep the market stress that was building very quickly from getting out of control. So yes is the short answer to the question, which is, are there liquidity problems that are going on sort of behind the scenes? And I would just say, sort of going back to what I was saying earlier, it's like, if you think about what was happening in the Treasury market with, the bid-ask spread, these largest moves we've seen in 40 plus years, at that time, the movements you're seeing in equities were kind of unremarkable. So, tremendous stress in the sort of core fixed income markets in the U.S. and equities just kind of whistling by the graveyard. So just keep that in mind.
Yep. All right, we're coming in on an hour here, so maybe I'll hand it off to Keith for any sort of final comments, and we can wrap it up there.
I just think that if we go through the next trading day and the next week, and we think that there's going to be this moment like where it's all solved, and we deny the fact that there's a Minsky moment that's already happening. I just think that we're so far away from you in terms of how we think about risk and the history of risk and the history of risk that's linked to recessions that you're not going to believe it. Right? I believe that we don't know how it's going to end. I'm going to end with what David said, which is just that. I mean, there is way too much. I mean, we could go through every single chart that everybody knows. The most debt, the most leverage in the system, in the history of the system, the most leverage in the options market in the short term, never mind in the aggregate of the options market, in the history. It's always, like, in the history of ever, that's still a very long time. And if somebody could tell me that it's just going to end because a bunch of the stocks that everybody already owns go up for a couple of days or weeks, well, that's great. I will believe them.
All right. Do you have anything you want to add, David, to wrap it up?
No, just that I think our job, our cardinal, responsibility is to carefully contemplate the fullest range of plausible outcomes and essentially assign probabilities, conditional probabilities to each of them, while rigorously avoiding being certain about anything.
Yeah.
Because you do have the intervention of, real live human beings. They don't know how it's going to turn out, and we don't either. I'll just finally say, Daryl, it is hugely interesting and in a certain narrow and precise sense, really fun to be doing this right now. I think
Cool.
you have fun. We have fun here, and I hope the viewers have enjoyed what we've had to say.
Yeah, absolutely. And by the way, thanks everybody for tuning in, and I'm going to give a shameless plug to Hedgeye Live, which is in a couple months in Stanford. All of us will be there. We have a great group of outside speakers. It's going to be a great social event. I know Mark and I are going to play tennis. If anybody wants to join us, that's great. But I think it's early May, Hedgeye Live in Stanford, so hopefully you can join for that. Take care.